David, thank you so much for coming back. The most tweeted, retweeted interview in F.A.C.E history. Looking forward to speaking to you, my trading warrior brother. You have the control of our television set.
Amazing stats. I wasn't aware of that, Dale.
Huh?
Those are some amazing statistics. I wasn't aware of that.
Oh, yeah. I mean, you know, months after people are retweeting your interview. What was it, from about 4 months ago, 3 months ago, buddy?
February, yes.
Okay. So that goes to show you that you can have some views that are more valuable than just what's happening today. And you're excellent at painting a narrative of what your views are, David. So thank you so much for coming back. And people could follow you at Global Pro Trader or go to your website. How about an update on the scenario that you painted in your last interview? Some of the markets have moved quite a bit since then. You know, I'd like to start with, I found very interesting, you know, I follow you on Twitter, David, and one tweet that you made was really thought-provoking. And I think it was during a Powell press conference, or maybe a Humphrey Hawkins day, and he talked about when they were going to end their draining of reserves. And I think he talked about late next year, which you interpreted as that's when the recession will begin. Do you remember that?
I honestly, I don't. I tweet way too much.
It was like you said, this is important. It's like Powell's giving us a signal of when they're going to stop draining. And he was talking about that it should be complete by the end of next year. So anyway, let's go with what you had planned to talk about. And did you defriend Facebook today?
I've not been on Facebook for the past few months, ever since the privacy issues came to light. Okay. But I'm not surprised. I mean, Jeff Gundlach called this a while back, and you know, as it's been tweeted a lot in the last 24 hours, Mark Zuckerberg has been selling his stock like there's no tomorrow in the past 12 months. And insider trading or insider sales are a clear signal of what's to come. So,
yeah,
the bigger issue is the leaders seem to be faltering. If you look at the FANG stocks, Netflix had an awful quarter, and the guidance was more important. The same with Facebook. And you know, the comments out of Facebook seem to suggest that, you know, it's going to get worse before it gets better. Now, Google is the shining light, but you know, when you've got 2 out of 3 so far are negative, there's only a few more that need to come out negative. And
yeah, like Apple next week, and then and Amazon. So right now the FANGs only have 2 teeth left.
Only 2 teeth left, and then I would throw in, maybe, if it's not in the FANG, but I'd be watching what Microsoft has to say as well.
Okay.
But the point is, once the leaders start to fall, if you go back and look at 2007 and 99, once the leaders start to fall, then you should be more concerned about the overall market. But you know, today I want to go back to your Powell comment. Yes, he alluded to the fact that they're probably going to end QT early, and Fed's Harker also said in the Fed member Harker also said in June, I believe, that they expect to halt their rate hikes in mid-2019. Now, that's more conservative than previously, you know, than has been shared with us by other Fed members, including Powell. So you can see that there's a slight reversal or retreat by the Fed here in terms of what they're doing on the balance sheet and with regard to interest rates. But we'll get into that later. I personally only see them being able to get 1 more rate hike in September, given what I'm about to talk about.
Okay.
But,
and you know, they have to go in September because just to show their independence, with President Trump talking about that he's a lower interest rate guy and he really doesn't like it, but he's going to let Powell do what he wants to do.
Exactly. I mean,
right.
If they really wanted to show it, they would raise 50 basis points. But yeah, I expect 25 in September. But there's a lot of headwinds they're running into in October in particular, and we'll get into that momentarily.
Okay.
But I just wanted to start out, Dale. I've got a lot to get through today, so
go ahead. I won't interrupt you. Go ahead.
No, please do. Please do. It makes it entertaining. But I just wanted to quickly go back to what I said in February, which was that we were going through what I called our Bear Stearns moment at that time. But we were sitting around on February 14th when we did the interview. The opening on the S&P was 2,700. We'd come off 2530, I believe, was the low. We went back down to 2550 in April. But since then, as I forecast, we're going back up to all-time highs. I expect the S&P to hit around 3,000. It's not hit an all-time high yet, but we have seen them in the Russell and the NASDAQ. So it's only a matter of time before the S&P follows through, in my opinion. And I say this because this, provides some credibility to what I'm going to say next or over the course of this interview. And I'll just skip through here.
Okay.
As I said back in February, that was the Bear Stearns moment. We're now heading into the Lehman moment. I am now looking for a negatively divergent all-time high in the S&P on the monthly chart, along with several other signals, which I'll get into later. But this will be one of the signals that tell us that a crash in stocks is imminent. Now, you could argue, well, we already have negative divergence. Well, that's not true because we haven't hit a new all-time high yet. But even if we get that, there are other signals that you need to look at. You can't look at any one signal in isolation. You need to have confirming signals with that. When you get multiple signals pointing in the same direction, you have confidence that a stock market crash is about to occur.
So are those the three momentum indicators you're using for confluence of this event?
Yeah, with regard to technicals, these are my favorites. Yes, the RSI and the two MACDs, but there are others that I look at too, and we're going to talk about those shortly. But
we'll also have it on the weekly too, right, David?
I look at multiple time frames. Yes.
Okay.
The monthly is a lagging indicator because it tags the end of the month. But you may see this ahead of time on the weekly and the daily for sure. And I look at all three. I mean, I even look at hourly sometimes, but you're absolutely correct, Dale. You should look at all of the time frames. My timing for this is ideally October. It's pre-midterms. Now, it could be slightly sooner or later, and based on the recent results from Facebook and Netflix, it could be sooner. But the point is that I believe October is typically the worst month for stocks. And it's pre-midterms, so ideally that's my target, but I'm not tied to a specific month. It can be slightly sooner or slightly later, but that's my forecast, and I'm looking for about a 30% decline. Could be more, could be less, but about a 30% decline. And lastly, the manner of the decline, in my opinion, will be a 1987 style crash, a V-type crash, as I call it. And why? Because stocks are 150% of US GDP today, and they're critical to federal tax receipts. So the Fed and the US government in particular can't tolerate a prolonged stock market downturn. Otherwise, you're going to blow up the US budget deficit. One would say it's already blowing up with the tax cuts, more spending, talk about 1.5 trillion infrastructure spending bill after the elections, and more tax cuts potentially. But if the stock market drops significantly, and it's a prolonged drop, that'll have a significant negative impact to federal tax receipts, which will impair the US government, the US deficit, and will raise concerns about the perception of insolvency of the US, which it all comes back to bonds at the end of the day to service US debt and their ability to issue debt, not their ability to repay it. They can't repay it. They are already technically insolvent, but their ability to issue new debt to replace the old. If the stock market has a prolonged downturn, people are going to question that. And that's why I believe the Fed will respond relatively quickly. But the Powell put is a lot lower than the Yellen's put or the Bernanke put or the Greenspan put. And that's why I say 30 to 40%. So let's get into why I expect a stock market crash.
What are the headwinds in October? I think there is something politically with budgets. in the fall before the elections. And just one more thing, I'll bring it up before I forget, David. If you're using the 1987 analog for the type of decline we're going to have, in 87 we peaked in August, broke for about 7 weeks, and then put in a failing rally. Could it be similar this time, that we peak in August as well?
It could be, as I said, it could happen sooner rather than later. And as the results from
I'm
Facebook.
just saying that's how it went down in 87.
Yeah, I'm speaking more to the pattern itself, the fact that it dumped so far, so fast in a matter of days, and then it recovered soon after. As opposed to the 2008 crash, where it meandered lower for a period of time from October 2007 until mid 2008, and then it dumped, like a lead balloon. I think this is going to be a shock drop, and then it's going to rebound on Fed reversal to QE, and global central banks do the same thing. And that's what I mean by 1987. It's not going to be a long, drawn-out crash. It's going to be relatively fast, in my opinion.
Okay.
So why do I expect a stock? And by the way, it's nice to see that since February, a lot of people have jumped on board on this call. I get into that later, but there's a lot of really good names that have come out and said that they more or less say the same thing. The beauty of that is that they come from different angles, and when you have different arguments for the same result, and they're credible arguments, it adds weight to that argument. So we'll talk a little bit more about that today. So quickly, this is, I want to first talk about global liquidity, and I expect that to turn negative in the, towards the end of the year and the start of 2019. Ron Stoifler put some great charts together on gold, but also on stocks. And he's got like 2019 turning negative. Now, why is this important? Well, global liquidity is everything to the stock market. Now, other people will debate or argue with me that the stock market rally since 2009 is driven by fundamentals. I call that hogwash. It's been driven by central bank stimulus. It's pretty obvious. When that punch bowl is removed, the stock market, like any Ponzi scheme, runs into trouble. If you don't have increasing inflows into stock market, they simply stabilize or fall, which would be the worst case scenario. The stock market's going to run into trouble. And according to charts like this from Incrementum and then this from Nordea Bank recently in June, they believe that, according to their indicators, liquidity is already dropping. And that's a major headwind for stocks going into the end of the year. So that's the first aspect of why I think stocks get into trouble in October, certainly Q4. Then we have Lee Adler, who's I think an aficionado on the Fed and their machinations. He's basically said that the Fed is going to cause another headache for the stock market in October, because it reaches its maximum drawdown of its balance sheet per month at 50 billion, or put a different way, 600 billion annually, and that the bond market can't absorb this drop in demand, especially when soaring budget deficits are adding 100 billion of new supply every month on top of the 50 billion in less demand. At the same time, you got the ECB, BOJ, SNB tapering their QE. Foreign central banks are buying less US Treasuries, and US domestic buying is becoming saturated. So who's going to pick up the tab for an extra 150 billion in net demand per month in October? I believe, and I think Lee believes, that the Fed will be forced to revert to QE to keep yields down and finance the ballooning deficit. He calls it...
Yeah, we can't count on China anymore, can we, David?
No, not China. And, you could debate even some of our erstwhile allies like Japan. They were buying last month, but they've been selling prior to that. So you can see that foreign demand for US Treasuries has waned. And this is a nice segue into the next point. So we talked about, global net liquidity. We talked about QT. And now I want to talk about what Luke Groman said on his Macro Voices interview, which was a fantastic interview, and I recommend everybody listen to it, where he talks about the Fed's impossible trilemma. And he credits another Irishman, by the way, Lewis Curran, for coming up with this. Basically, it's this. The Fed has three priorities: low bond yields, and the reason for this is they can't allow bond yields to rise dramatically, as that would sink risk assets, most notably the housing market, which we're already seeing is running into trouble recently, and balloon the debt interest costs and the budget deficit. The bond yield is the risk-free rate for everything, including stocks. So if bond yields take off, the risk is everything collapses in this everything bubble. Second is a higher stock market. I just talked about how stocks are 150% of GDP. The federal tax receipts rely on the capital gains from appreciation in stocks, taxes and IRA distributions, and wealth-driven consumption. They're all key to US finances and ultimately US solvency. So they need a higher stock market. But thirdly, there's the dollar. Now, late last year, the Fed noticed that a weaker dollar pushed bond yields higher. At the same time, Treasury issuance was soaring due to the rapidly rising budget deficit, and the Fed was reducing its balance sheet, again QT, at the same time. So in February this year, the Fed began actively supporting a stronger dollar. However, as we've seen recently, a stronger dollar may help keep bond yields down, but it also has other negative side effects. It's creating enormous stress on the emerging markets that have borrowed heavily in dollars and risks global contagion, and that could spread to banks globally. Jim Rickards pointed this out recently. There are a lot of derivatives tied to emerging markets, emerging market currencies, bonds, and stocks too. We've seen the effects in Argentina recently, and Turkey already. Contagion in and of itself could cause US and global stock markets to collapse. So another aspect of the strong dollar is imports become cheaper. You increase the trade deficit. We're not seeing it yet because it's a lagged effect. Everybody's looking at the trade deficit falling and saying, you know, Trump's tariff policy is obviously working. It has nothing to do with it. The dollar fell 14% from January 2017 through January 2018. That's a lagged effect. It doesn't happen overnight. It filters through, and that's what you're seeing. Watch what happens later part of this year now with dollar strength. You're going to see that trade deficit go back up again.
Even though it's only been a 50% recovery? Yeah.
You're going to see it go back up again because twofold. It's been a 50% recovery, but it's going up, number one. And number two, you've got these tariffs on top of it. Okay. So that's slowing down global trade. So
bye-bye tax cuts and any benefit from that.
I'm sorry?
Bye-bye benefit from the tax cuts.
Yeah, I was going to get into that. That's another headwind for stocks coming into the end of the year. The only people would ask, well, if QT is, or QE is, global net liquidity is turning negative and we got those QT happening, why are stocks still going up? Well, you still have net positive global liquidity and you have a lot of record stock buybacks. And that's been driven by Trump's tax cuts. A lot of money's come back to US corporations. They've not been told to do anything with it, you know, like create jobs. They're plowing it all into buybacks. And that's what's keeping the stock market afloat and pushing it higher. So stronger dollar, the last point on the stronger dollar, it also weighs on the dollar value of foreign earnings for US multinationals. I mean, if the dollar is going up and you've got business in Europe or India, China, wherever, the dollar value of those foreign earnings drops. And that's not good for the stock market, especially if it's the big boys that are driving the bulk of the gains on the S&P and the NASDAQ.
So are you looking for a continuation move to the upside in the dollar, David? We've stalled around 95.5 3 times. You're looking for us to penetrate that and the dollar to make new recovery highs here?
I think the dollar, you could still see some further downside. The previous guys on, I agree with their view with regard to the euro 118.50, potentially up to 120. Those are huge.
Yeah, that was me.
Oh, that was you, Dale. Okay, sorry,
yeah, that guy. Yeah, it's all right. So you think so that would do you think that if we got that break in the dollar that would most likely, I would think, extend and be supportive of the stock market a bit longer?
Yeah, that's my point, that in the short term we go to all-time highs. I mean, even with the
Okay.
Facebook and Netflix, I still see us getting to October new all-time highs on the S&P. I could
Okay.
be wrong on this one. I'm not tied to it, but
Yeah.
a slightly weaker dollar would certainly help with that. But to your question, I think if we do get a crash, just like in '08 and in previous crashes, the dollar is going to see a benefit initially. The dollar is going to go up, and
Okay.
it's a safe haven currency. And it'll go to higher highs yet. It hasn't peaked, but I think it could go down a little further for now, help the stock market, and then when the crash occurs, it pops. But that's the blow off top. Once the Fed reverses course following the stock market crash, which I fully expect them to do, as you saw from the previous slide I put up, the Adler also expects when they return to QE. That's the dollar's toast at that point. And I know a lot, I have friendly disagreements with people on Twitter about this. There are a lot of people out there that believe that the dollar is going to 105, 110, 120. It could. Anything's possible, but I seriously doubt it. Because if you think about it, what's been driving dollar strength has been divergent monetary policies. You've got the Fed executing QT, or the balance sheet reduction, and raising rates, while the rest of the world is still undergoing QE. Draghi's the most dovish ECB or central banker in history, apparently, and you've got China easing now as well. Now they are slowly tightening, but it's nothing compared to what the Fed's doing. If the Fed suddenly flips overnight, that support for the dollar is gone, and that's my view on the dollar.
Okay, so let me, dollar's pretty linked to what's been happening in precious metals, David. So last time you were on, you showed a picture of Putin and Trump and Xi, and you said these are the three guys that make me like gold. So we've continued the decline. You know, we recently got as low as 1210. Is it possible that gold doesn't bottom until the Fed reverses course from in October and begins to ease again until the dollar peak? And how do you handle accumulating during a market that's in a decline when you have a macro bullish view, but on perhaps a shorter intermediate term view that instrument is under pressure?
Well, first of all, I'll deal with the latter one first. I got a question yesterday about miners, given what my views are on the stock market and with respect to gold. What do I do? And my answer is this: have a position, but don't load up. So if you're wrong and it just goes straight up, then you've got a position and you can just add on strength. If you're right and it does go down, gold and miners even more so, then you have the opportunity to load up at lower prices. So the way I would say it is, the answer I gave on miners, yes, it was I hold a 30% position of my target allocation, and I expect miners to go lower, but I could be wrong, so I'm hedging my bets by buying 30%. But if it does go lower, and significantly lower, I'll be able to add 70% when it gets down there. So that's the way I would do it. You know, it's not black or white.
It's not easy.
It's unfortunately nothing is with all these billionaires.
Right. Okay. And the miners recently have been acting a little better than the bullion. For the last 6 months, when gold was 1360, you could have looked at any mining index, GDS, any of them, they weren't close to those highs. So they were telling me gold wasn't ready yet. So that's going to be an important thing to keep an eye on. You want to see the miners lead it, don't you?
Well, I'd be happy at this point to see the miners, silver or gold. But I'll say this with regard to the miners. Yeah, I've heard that argument, but if you look back at the chart of miners relative to gold and silver, look at it, the miners have basically gone sideways for quite some time. So they didn't really follow the recent pops in gold and silver either. And
that's what I mean.
Yeah, and they're not following on the way down. So they're kind of like, zombies right now, just trying to figure out which way to turn. And so any one of of them could lead out, Dale. They have passed the parcel in previous times. Gold has led before silver and miners. With a stock market crash, though, miners are stocks, and I expect them to get, I use the term, annihilated when this crash comes. Now, typically gold and silver do well in crashes, despite what people think. 2008 was an aberration because they were hammered lower by bullion banks, and Dmitry Speck does some great work on this, and you can read his book, but he provides a graph in there which shows clearly that they were hammered lower to protect the dollar and the fiat currency system at the time.
I see.
But that doesn't mean they can't do it again in the next crash. And miners will, suffer like every other stock when this stock market crash, perhaps
That's a great
to a lesser
point.
extent.
Most people don't really get that. That's an excellent point, that they may not be immune during the initial phases of the crash.
Exactly, but when you get any whiff of Fed reversal, like we did when in March 2009, with regard to QE1 and QE2, miners are going to outperform. They outperform gold and silver on the downside. Silver outperforms gold too, but on the upside, they vastly outperform gold and silver also. So the idea being that if they do get hammered with a stock market crash, you better have your dry powder ready. Yes, because those things are going to just take off once the Fed reverses course. And you just have to take out a chart and look at gold and silver and miners when the Fed executed QE1 and QE2, and you have your answer. So,
any view on oil, David? We've had two highs recently that have both corrected sharply. How does oil play into your scenario?
Well, I was hoping for, is the term I would use, a peak around $80, but it may have already peaked. But the point is, I agree that it looks like it needs to go test support a little further, 66 or 65, and then it'll go higher again. The question is it going to go to a higher high or a lower high? Personally, I'm still looking for a higher high around $80, and based on Fibonacci levels for the entire drop from 147 down to 26. And
what is that, 61.8 back?
Yeah, 61.8%. Yeah.
Okay.
And there's another one from its more recent peak at, I believe it's 107. I'd have to dust off my memory on that one, but it's a 76.4 and a 61.8% retracement level. So anywhere between 76.50 and 81. Now, I expect, like, the way oil performs looking back over the past 20, 30 years is it tends to go up steadily and then it gets absolutely hosed. And if you think that, just look at the chart. 2000 to 2001, it dropped 54%. 2007, 2008, it dropped 77%. And 2014, I believe it was, I haven't got the figures in front of me, it dropped to around 70% again. So it goes up steadily and then it gets hammered. But if you look at each of those periods, especially 2000 and 2008, they were tied to stock market crashes. And so oil tends to follow stocks down. So to the extent that we have a stock market crash, oil is going to get hammered again. And that's what I think we're heading up into, to answer your question, a peak in oil, and then it goes lower. And it's no coincidence that Aramco pulled their IPO, given what I anticipate is going to come in terms of stocks and potentially the oil market as well. I mean, you're not going to issue or do an IPO when oil's getting hammered. You want to, see renewed confidence in the oil market to get the best bang for your buck if you're selling 5%.
Yeah, you would think that they would put it on the IPO it today with prices here or at 80.
Yeah, I think.
Get there.
Yeah, but if you think about it this way, if the Fed does reverse course and global central banks reverse course post this crash in November or December, whenever that is, or maybe Q1, risk assets, we're jumping ahead in the presentation here, but risk assets are going to explode higher.
You'll be able to buy the world. So short the world into October and buy the world when the Fed flips, commodities included.
And I make this point yesterday with regard to the dollar on sentiment, from a sentiment perspective. You were talking about earlier. The dollar fell slightly yesterday from a sentiment perspective to 79 at the DSI. It's been as high as 96 recently. And everything else, literally everything else, went up, except for, I think, cocoa and a couple of other items that were flat. But the only asset that was down yesterday was the dollar. Now, what does that tell you? It tells you that when the dollar flips and goes south, everything else is going to skyrocket. Commodities, bonds, stocks, the precious metals, you name it.
It's the I call it the linchpin, the fulcrum of the
Exactly.
wheel.
Which goes back to this, the impossible trilemma that Luke Roman, Lewis Curran, and myself have been talking about, is that Fed is trying to have its cake and eat it here. They want to have low bond yields, a higher stock market, and a strong dollar. Well, no, you can't, because the strong dollar is putting pressure on the stock market, and based on possible contagion from emerging markets, and also it's going to impact earnings for multinationals, etc. And you're seeing that stress from the dollar, but also from QT on the stock market. Now, Powell said in response to questions about a couple of months ago, when he asked about the dollar's effect on emerging markets, his response, and I'm paraphrasing, was more or less, they're on their own. They can, with respect to the dollar strength and its impacts, emerging markets are on their own. But the takeaway from that was that Powell is likely to continue to tighten Fed policies until something breaks, and that is likely to be the stock market, because there's pressure coming from both ends, from QT and the dollar on the stock market. And once my point is, once the stock market falls, the Fed reverts to QE. They're using the strong dollar to prop up the bonds and keep bond yields down. Once they revert to QE and post the stock market crash, they don't need the dollar anymore to do that. They can simply buy the debt through QE. So they can keep bond yields low. They can do what they did since 2009, push stock market higher through stimulus. So the dollar can be sacrificed in the process, because that will enable them to push inflation higher. It will also improve multinational earnings, yada, yada, yada. So if it's a choice between, if you've got 2 out of 3 you can choose from the Fed's perspective, they're going to choose number 1 and number 2. And it's the dollar that's going to be sacrificed at the end of the day.
That's been the track record.
Yes. Now this is where I use this, what I call holistic approach, or as they say in investment circles, the mosaic theory. Take disparate pieces of data and put them together, and you start to get a picture like pieces of a puzzle. Another one here is, go back and look at Fed speeches from various members of the Fed, or all of them, over the past 3 months. I don't read through every one, but I do look at several reports on what they've said. And it became very clear to me that there was a concerted effort on the part of the Fed to blame Trump for any potential crisis in the near future. And I had 2 takeaways from that. Why are they trying to blame Trump? Because they don't want to divert blame away from themselves, as per usual. But why did they need to say this, and why are they all saying it? Well, obviously they think something bad is about to happen, and they don't want to be the one blamed for it. And
so does he.
He doesn't either, as he's
he thinks something bad's going to happen. It's the first time he's talked about he's a lower interest rate guy. Yeah, but he's going to let Powell do it. So he's setting up the fall guy too. So what you're saying is there's a war. I didn't know the Fed was doing what you're saying it was doing already, blaming Trump for potentially what could happen to the markets. But this was the first time Trump came out and said he didn't like what the Fed was doing.
Coach, David, hi, Steve. Sorry to interrupt, and it's very unusual that I interrupt, but I find your interview very interesting. You talked about something that I've talked in the past. You said that they're about to blame him, but I was also talking the other day, and they said the following, and I want your opinion on that. He's making it extremely easy.
Yes.
Because candidate Trump was explaining constantly to the people why the economy is flawed. And just a year after he took power, he's trying to explain to people why his economy is doing magnificently, and it's the best economy the US has had in decades. So now he has painted the target on himself, and he will take the fall for things that are indeed not his doing, right?
Absolutely, and I don't want to put on a tinfoil hat here, but I agree with you completely, Steve. The question is, I don't think Trump is stupid by any stretch of the imagination. A lot of people say that about the Fed too. What they're doing is they just don't know what they're doing. That's the easy way out. The more
They know what
active,
they're doing.
They know, absolutely know exactly what they're doing, and the idea that these guys are, morons or something is just preposterous. It's just, you don't want to believe the boogeyman's in the closet. The Trump is, as Steve pointed out, if you're a globalist, he's performing perfectly. He's doing exactly what they want. Why? Because he's doing everything anti-globalist. Everything. And when it causes a crash and an economic recession and the GOP to probably be wiped out at the midterm elections, they can point the finger at Trump and see, look, there you are, you populists vote for this nationalist and just make America, and look what he's done. When you don't blame the last guy to the party for the mess that follows. He just walked in the door. It's Fed policies that have caused it, central bank policies. But he is playing his part perfectly.
Herbert Hoover agrees with that.
Yes. Now, whether it's by design or it's just, he's clueless. You make up your own mind. But personally, I think it's by design, and that's why I say this is all theater. The Fed wants to be able to blame Trump because A, they always blame somebody else. B, when they revert to QE, they want the people still have confidence in them. I mean, it won't last, but at least in the short term, when they revert to QE policies again, they want to be able to point the finger at Trump and say, look, he's the problem. Because if they were the problem and then they go back to QE, nobody's going to buy it. Everybody's just going to go, oh, here these guys go again. They're just making matters worse. But they have been blamed. And so I agree with your point, Steve. If you look at what the Fed speakers have said, they're blaming Trump's trade policies for all the problems that's been caused around the world. Yet, I think I have a chart here on this. This is the S&P. What happens every month end? It's called QT. That's the Fed. That's the Fed reducing its balance sheet. Look what happens to the stock market every time it comes into month end. It goes down. Not the trade war. It's the Fed. And yet the mainstream media, it keeps trying to, say, oh, Trump's trade war, it's ruining the stock market, it's ruining the world. It's not. It's central bank policies. And then you've got, foreign policy. They talked about North Korea and Iran and the potential risk associated with that. Fiscal, this is a great one. This is spending money to support the economy today, but that means we have no bullets left in the gun for if a recession hits in the future. So he's taking away our dry powder now, which is probably not a good idea, and therefore they can point the finger at him again, like, oops, we're in a crisis now, and you've already spent all of our, any ammunition that we could have used on the fiscal front. Immigration, low-cost labor. That's one of the reasons wages are going up. Come on. I mean, he's only started doing this in the past year or two, so wages will suddenly start going up because, less Mexicans are coming across the border. I mean, and then regulatory, Brainerd's be able to say, I voted against this. Fed's Quarles, the new member of Fed Quarles' idea to take away some of the Dodd-Frank laws with regard to proprietary trading on the part of the banks. They're in the process of being diluted. That was a 2-to-1 vote at a Fed committee, and Brainerd was a dissenting vote. She said we should keep them in place. Well, then they can pry to Trump, oh, you deregulated the banks again, and look what happened in the space of 6 months. Yeah. My point is they're trying to hit him on every single front, and they're not just doing it once.
It's all set up.
They're doing it repeatedly. This is coming on repeatedly. So that's another sign to me that not only do they want to blame Trump, but that there is a crash coming? Why would you go through to all this effort to say all of these things across all of these points unless you expect a crash ahead and you want to be ready to be able to point the finger? And then, you know, we've got this trade war. That's what I call mainstream media supported pure theater for what's really happening in the world economy and world markets today. It's the central bank policies that are driving everything. And, you know, I think this chart illustrates it fairly.
So the trade war is a sideshow.
It's a sideshow. I mean, yes, it will have, if all of those tariffs are implemented, it would have longer term impacts. But in the short term, it's having very little impact. It's central bank policies that have a more immediate impact on what's happening in the world.
Does this analog remind you of 37 when the Fed was tightening after we were coming out of the depression of the early 30s?
Yes, it does.
Some similarities here.
Yeah, absolutely. There's a quote, and I might have it here later, that in the past 100 years, every time the Fed has raised interest rates, we've had a recession follow soon after. And you know, hopefully I have it here, but the point being, you're absolutely correct. They're tightening into recession, and that's what you bring up another point. All this stuff about strong growth, and they're shooting themselves in the foot to some degree, but they keep saying it anyway. The Powell came out and said, you know, we're going to continue our policies, gradual rates and balance sheet reduction, and we can because we're seeing inflation, green shoots of inflation and robust international growth. Well, he said this back in May. Well, you know, now we've seen what's happened around the world with Argentina, Turkey, Brazil, Europe. The zoo survey in Europe has been horrible recently. And so that's been shown to be hogwash. I mean, it's pure propaganda. If you look at the micro data in the US, and I say this on Twitter a lot, you look at credit card receivables, you look at auto loan defaults, you look at mortgage rates, mortgage delinquencies. These are soaring. The consumer is spent, and yet when you look at the GDP numbers and the retail, everything's rosy. Well, first of all, the GDP deflator that's been used in the GDP number is incorrect, let's put it that way. And the retail sales number just reflects inflation. It doesn't mean actual purchases have gone up. And I could go through all of that, and don't get me started on the unemployment numbers. When you got 100 million people employed, it just...
David, just a few years ago, like 20 years ago, the unemployment rate was counted with what we have now as a U6, right?
Yes.
So U6 is currently at 7.8, and like roughly 20 years or a little bit more ago, that would have been the main number, right? And now we've just started ignoring people that are part-time workers, people that have been out of the workforce for 1 year. So obviously that's skewed as well. And about the deflator, I've been saying the same thing. I mean, is there really somebody that believes that the CPI we're seeing is the actual one? I mean, you just have to live in the real world to see that. And even if we take that into account, the CPI has hit 2.9%.
Yes.
Right. 2. And PPI is 3.4. So it actually shows that CPI, you know, has an upward momentum.
Absolutely, and I agree completely. Again, you know, they changed the measurement for the CPI back in the 80s to show a lower CPI number, and use these hedonic adjustments and so forth, which are completely preposterous. They're an arbitrary method of measuring inflation, which basically means they can make it up as they go along. And the obvious reason is that you can have 10% inflation, which John Williams at Shadow Stats shows that the current inflation rate is closer to those numbers on an annual basis than the published ones. Why? Because you can devalue the debt, you know, 8 to 10% on the dollar, that is, over time, which makes it more manageable in real terms. At the same time, you don't have to pay people more Social Security because the official rate is only 2%. So it's robbing from Peter to pay Paul, Peter being the public, Paul is the government. So I completely agree. But going back to the main point, which was the numbers that were being told about the economy are silly, and a great chart you should look at is federal tax receipts. Now people will say, well, tax receipts were cut this year, that's the reason why they're going down. Well, they weren't cut in 2017 and 2016 and late 2015. And if you look at a federal tax receipts chart, they've been negative, in and out of negative. since then. So we've been in and out of recession for the past 3 years. You know, those are the cash flows, you know, that you look at for a company. Those are the cash flows for the economy, and they show that the economy is in recession. So when I hear all this stuff about growth, and we're about to get GDP numbers tomorrow, and it's going to be 4%, it just makes me smile, and it's silly stuff. I also go back to the reasons why I expect a crash this year. The commercials and the bonds, the smart money, the so-called smart money, they're near record long U.S. Treasuries. Now, if the economy is doing so well, and you know,
they're looking for lower yields.
Absolutely, they're looking for lower yields. And Lee Adler's talking about all this increase in supply from massive budget deficits, and then the drop in demand due to QT starting in October of 50 billion, or a run rate of 600 billion a year. Why do the smart money think yields are going to go down?
Risk.
What could cause bond yields to drop? Exactly. These guys are set up perfectly, and of course the hedge funds or the large speculators on the other side are completely wrongly positioned.
That's the most embraced narrative in the market. I've talked about that in several interviews. The one narrative everyone accepts is the bonds are in a bear market.
No, well, they are in a bear market, but that bear market, they're in a secular bear, or I would say a very brief bear. But no, the Fed cannot, going back to, you know, the trilemma that Luke Rowan brought up, the Fed can't allow bond yields to soar. That's the end of everything. If bond yields were to go to 4% or north, you blow up the budget deficit, you blow up every derivative tied to the 10-year risk rate, you blow up the housing market. I mean, I could just go on and on. Everything falls apart. It's critical. And they've been relying on, you know, money market funds in the US, which they forced to buy these US treasuries. They're forcing the banks to buy, the commercial banks, the big banks, to buy these treasuries. At some point in the future, they're going to saturate that demand, and they're going to have to, you know, go back to QE. And that's another reason why, you know, they would want to crash, so that they can do that. So they can revert to QE, buy the debt, monetize it, and keep bond yields down, because the bond yields are bad.
David, what do you think will happen to cryptocurrencies during this type of scenario you're predicting in October?
I think, you know, Chris, cryptocurrencies are looking, like I said on Twitter there recently, that they're going to go through another round of euphoric demand here, in my opinion. Tinfoil hat, it's to help divert demand away from gold, which is also about to take off. And I think they will perform extremely. They won't do too well just beforehand, but and when the crash is underway, just like gold and silver. But once the Fed reverses policy, they'll take off. But I don't think the authorities, the establishment, is going to allow cryptos to persist much longer. The whole purpose of cryptos, in my opinion, and I know I'm going to get trashed for this on Twitter, is to promote digital currencies, and
so that the government could have their own.
Absolutely. The Fed coin has already been prepared. Putin's talking about the ruble, the crypto ruble, etc. And then ultimately you're going to get a digital SDR. So that's where I think that's what I think is going to happen to crypto.
So they let the experiment go on for the general public to embrace it. So it won't be a radical thing for people to accept it coming from the government, and let all of these thefts that happen online, they could sell it as a secure digital currency.
Yeah, yes, and the establishment will not allow anything to compete with them. Now, could crypto succeed based on, you know, popular demand? Possibly, but the establishment is going to do everything in their power to limit any competition to their digital currencies. Put a different way, banks are not going to allow you know, individuals to create shadow banks to take their business away, and the bankers rule the world. So the bankers are going to use every method to shut down cryptos once they start rolling out their digital currencies, in my opinion. Whether they succeed or not, that's another question, but that's what they plan to do.
Because it certainly is easier to carry around a little, I don't even know what a wallet looks like, David. I asked someone I interviewed about crypto if for baby boomers like me, they could make their wallets leather bound. But they're definitely portable, right? I mean, you could just have a little computer thing you put in your pocket with all your wealth and go anywhere.
Yeah, you can use a flash drive.
Yeah, that's what it is. Flash drive.
You just, you know.
That's even an advantage over physical gold and silver, isn't it? I mean, try and transport metals across borders.
Yeah, but for me, I have no issue with that, to be honest.
Yeah, because you're already dug in.
Yeah, but I mean,
you're not going anywhere.
Yeah, but transporting it across borders is not an issue for me, to be honest. Just transferring it from one depository to another, or foreign exchange deal. You sell your gold here and you buy it somewhere else, just like you would sell your Canadian here and you buy your US dollars there. Okay. I find that argument, it's valid to some degree. It's not as instantaneous or not as easy as it is with cryptos.
Right.
But the bigger issue is the store of value. What's portability relative to store of value? Bitcoin soared last year, got crushed as I anticipated in December once the futures markets came around, and now it's getting signs of life again, and we're going to go up again, and then it gets crushed again. Some would say, well, it's the same thing with gold. No, not to the same extent. It's far less volatile than Bitcoin. I mean, you had graphs of tulips back in December. Gold has never done that. So
yeah, they've approved senior citizens can hold precious metals compared to crypto because the volatility is so low. So ARP has approved it, American Association of Retirement.
Oh, okay. Also, guys, gold is never going back to zero simply because it has physical attributes that will always, help it retain some value no matter what. I mean, there are several things that you can do with gold that humanity has been doing with gold in the ancient times and today as well. So there is no question gold does have intrinsic value. But David, if I may, I wanted to ask you one question. What are the chances? You talked a little bit about a potential end game. And in my opinion, a potential end game, which is what? Getting again what we got in the 70s, which is stagflation, are much higher than the market thinks. So, for example, the chances of actually getting some runaway inflation at the same time that the economy is going to be tanking, I think that, the markets don't even take it into account. I mean, they do think that during the next recession, whenever that happens, we're going to have the same story repeating itself, like bonds, treasury bonds, etc., getting paid, so yields going down, and the economy obviously suffering, and employment going up, and at some point, stabilizing through monetary policy, and rinse and repeat. What if this time, especially given the dire situation with deficits, debt, etc., the market loses its faith in the treasuries, loses its faith in the dollar, and we get stagflation? What then? First of all, do you think this is a possibility?
Not only a possibility, that's my view on what's going to happen in 2020, 2021 timeframe. We're going to get this, that's exactly my outlook. That's why I'm holding gold and silver, and I expect it to go multiples higher. QE does absolutely nothing for the economy or Main Street. Nothing. It's like, it's you just have to look at real wages since 1989. The consumer is tapped out. So when they roll out QE again to basically boost the economy again, they'll boost assets maybe, but they're going to realize that they can't fool everybody any further. So you're already starting to see helicopter money. I mean, the subsidies to the farmers due to the tariffs, I call that the first instance of helicopter money. We're talking about universal income benefits, which is another ridiculous idea, right up there alongside negative interest rates. Negative interest rates pay somebody to borrow money from you, and universal income benefit, we're going to pay you for doing nothing. So they're going to roll out these programs after the crash, and the crash will be the excuse to do so. And the idea would be that they need to keep the engine of consumption going. So they're going to flood the economy for the first time with liquidity. Well, the number of goods produced isn't going to go up dramatically overnight. And I like to look things in simple terms because then it's easy to understand. But if you've got more dollars and euros and yuan and yen chasing the same amount of goods, what do you get? You get inflation, or as Steve just said, stagflation. And that's exactly what I expect. That's what I anticipate. We talked earlier about Aramco and pulling their IPO and what QE will do for that. Oil's going to soar to triple digits. Gold's going to soar. The can of Coke is going to soar. That's my anticipation, that you're going to run into an issue of stagflation. And the culmination of these events will be the end of the dollar as global reserve currency, a switch to probably the SDR, or supranational currency, and a debt jubilee across the world, in the US, Japan, etc. And that'll be the global monetary reset. But prior to that occurrence, you're going to get stagflation. And then when they do that global monetary reset, they're going to have to do it in order for it to work, unlike what the UK did with the gold standard in post-World War I. You're going to have to do it at a value that is somewhat inflationary on top of all the inflation already underway in order for it to succeed. And that scenario, then gold, silver, they all just explode. Commodities explode, and this is all supports the whole view of commodities. Look at what commodities have done, like coffee, cocoa, sugar, live cattle, soybeans, cotton, you name it, wheat. They've all been absolutely hosed recently, and they're about to go into a major bull market here in the next 20 years. They're going to absolutely explode higher because currencies are going to be debased on steroids. And that goes to your point, Steve, with regard to stagflation. It's going to be like the 70s, but even more so because the amount of energy that's being built up with all of the central bank printing on top of what's going to come, Dale, I shared with you in February, I expect monetary insanity on steroids. It's not going to be just QE. It's going to be NERP. It's going to be asset seizures. It's going to be wealth taxes. It's, it's going to be physical cash ban. It's going to be the whole kit and caboodle next time around. On top of what's already happened.
Compare the state of the economy in the 70s, which had the potential of rebounding, easier, with the current state of the economies. I mean, back in the 70s, the US was still probably the biggest creditor nation on the planet, and it's currently #1 debtor nation on the planet, right? So obviously not if there was a worse period for that to happen, obviously it's now, not back then.
And they made stuff back then. Now it's a paper economy. It's being fully financialized, more or less, which Absolutely. Trump's trying to reverse, but he's trying to reverse too quickly. That's the problem. And the other thing is that the debt numbers, going to, one of the issues with regard to Luke Roman's comment on the trilemma was that, could they, if inflation takes off, by going back to QE, can they just jack up rates? No, they can't, like they did back in the 80s to deal with the weakening of the dollar. Couldn't they do that? No, they can't, because the debt is far, far, far greater today than it was in the 70s, to your point, Steve. And the US economy is a shadow of itself back in the 70s, and more so back in the 50s and 40s post-World War II. So yes, it's a very different situation that we have today, and absolutely I expect stagflation. But let's get back to just to finish on the points on why I expect a crash. The copper curve, not many people watch this anymore, but it predicted the 2000 crash, it predicted the 2008 crash, and it's telling you something right now with regard to the current state of the market as well. Just I reference that because not many people watch it, and it's raising alarm bells too. And by the way, it's not just 2000.
And much longer,
you can go back to this past century and look at it and see it. Dale, you and I said at the end of the last interview about goals, follow the smart money. Well, the same thing with regard to the stock market. The elites like to tell you in advance what's coming, the IMF, etc., so they can say, I told you so after the fact. They don't hide the fact of, with regard to what's coming. Jamie Dimon basically warned of a panic in May. That panic was coming due to QT. He's done it 3 times now. He came out again there recently and said so. Dalio is short. on all financial assets for 2019. You know, he may be conservative in 2019, I expected sooner, but the fact is he's short. And Buffett has the highest amount of cash on hand ever. It's the sad part about Warren Buffett is he's a fantastic investor over many years. But unfortunately, I feel like he's a cheerleader for the establishment now, because he says one thing and he does another. He's saying the economy is great, you know, stocks are great value, and yet he's got the highest amount of cash on hand in his portfolio ever. What's he waiting for? I think he's going to go bargain hunting here in the next few months. That's what he's waiting for.
Well, he says that so he could offload his shares. He needs buyers.
Well, I'll let you say that, Dale.
Okay,
I'm already
well,
going to get flagged on the cryptos.
Okay, all right. You know, I think they all do that, buddy.
Yeah, no, I agree. But
Okay.
you know, I'm going to get
The
some
Crash Club. Where do we get our sweaters?
I put
Or
this thing in the
jackets.
Crash Club because when I made these statements back in February, I was one of the few, and now I see a lot of names coming on board. And I just threw this up there so that you can see it's not consensus by any stretch of the imagination. I hear this a lot. A lot of people think this, but as Steve pointed out with regard to stagflation, a lot of people think it, but few people, it isn't in the mainstream yet. There's a lot of people who are thinking about this stuff, but it's increasing, but it's still a very tiny minority relative to the broader market. The answer, the counterpoint to that, oh, well, this is becoming, because everybody thinks this, then why is the stock market going up? If everybody was thinking that we're going to get a crash tomorrow, why is the stock market going up? You know,
right.
Last fool theory, I'll be out before anyone else, maybe. So there's a number of quotes there. Enjoy afterwards. I like this last one from Macquarie. Fed will halt its balance sheet reduction in 3 to 6 months. He captures it perfectly, which ultimately leads to, and this is my view, a world of pervasive negative interest rates, QE, and CBs do everything in their power to prevent the zombie system from collapsing. I mean, I couldn't put it better myself. That was really well said, and that's fully what I expect. And that goes to the whole stagflationary discussion we just had. The Fed itself has given you a heads up on multiple occasions that this is going to happen. Powell says upon nomination, this is the strangest comment to say when you're just taking over the Fed, when everything's supposed to be wonderful, Goldilocks. We must be prepared to respond decisively and with appropriate force to new and unexpected threats to our nation's financial stability and economic prosperity. I thought everything was wonderful. Why are you buying insurance all of a sudden? And then you've got Yellen before she, was told she was not getting the job anymore. Yeah. Fed may have to turn to QE in another downturn, absolutely. And then even Williams, who's now the New York Fed head, he said he was talking negative interest rates in the USA in 2017. So they're already giving you a heads up for what's coming. And, all of the data that I'm seeing suggests so too. The last thing I wanted to say was signals that I'm watching with regard to when the stock market crash is about to occur. I already mentioned negative divergence on the S&P on the monthly chart. Again, you can look at the weekly and daily for an earlier warning. Widening credit spreads. If you see widening high yield or investment grade credit spreads, credit leads equities. Equities are the dumb money. Credit is the smart money. High yield peaked in May-June 2007 before it absolutely dumped, and equities peaked in October. So high yield gave you a heads up in advance. And you've got falling treasury yields. Treasury yields peaked in July of 2007 and were falling before the equity markets got the memo. Then you have the yield curve. Everybody focuses on the negative yield curve. Actually, what the concern would be the hockey stick. When you see the yield curve hit a bottom and start to go back up, the 2-10-year yield curve, that's when you need to be worried. In March 2000, and when was it here? I think it's around June. November 2006, it bottomed then as well. And then the yield curve started to rise.
Isn't that interesting? Most people are worried about it, the yield curve going negative.
Yeah, and why is it going up and going into a crash? Because, as I just said, yields were falling. They peaked
It did that in 87 too, David, with your analog. Rates were going up dramatically.
Yeah. So
The bond market peaked in April of 87. I'm a historian.
very good.
All right.
So the yields fell. The yields fell, started to fall in 2007 to 2008 ahead of stocks.
Right.
And then you had the yield curve start to go up.
Great point.
How is that possible? Well, short-term yields dumped. They fell faster than long-term yields. That's why the yield curve was steepening. That's the hockey stick. And here we are here. And you don't see it on this chart because this is a monthly chart, but we actually get down to 24 basis points, and we could go lower yet.
Yeah.
But when you see this, it started to creep up again recently. If you start seeing this hockey stick and those other indicators as well, that's a major signal that trouble is brewing for stocks. And then, of course, there's the VIX.
Yeah.
Watch the VIX. It got down to, in January 2007 to a low, and it started to set higher lows from that point, and then you're starting to see the same thing here.
Still have a higher low, but it's almost at new highs in the market.
Sorry?
We still have higher lows in VIX with the market almost at new highs.
Yes,
so
exactly.
I don't think we're going to see 951 even if we get new highs. Do you, David?
No, along with the other signals, I'm planning to. I've already added some QQQ puts. Thank you, Facebook. But I'm layering in once this starts to get around 11. I'm going to layer in. We may get down to a 10 handle, but you're not going to get down here again, in my opinion.
Yeah. Okay.
And then you've got dollar yen. Dollar yen peaked in when was it? June 2007, and then boom, the yen, which is a safe haven currency, which is the most preposterous thing on the planet, given what they do with they're giving them much money to print. But that's what happens. Dollar yen collapse. I'm seeing signs of this already, and Steve can talk to this too. If you look at the DSI in the yen, it went down to the teens there recently. It's popped back up to 29. It's in the 20s, but I could see that falling again to a higher low, and then you have a higher price, higher dollar yen, but a higher low in the DSI, and then dollar yen dumps. But the point is, once you start to see this play out, dollar yen falling, that's another signal that trouble's brewing. But one of my main ones, and I do love sentiment, if you look at the DSI going back to 2007, 2008, it peaked in May 2007. The spot was 93, and this is for the S&P. The 21-day moving average was 89. And then you fast forward to October 2007, it went down, you can see this drop here, and then it went back to a peak of 88, which is a negative divergence at a higher high in price, and the same on the 21-day moving average, it was 83. So you had a negative divergence not only on the RSI, the MACDs, on the technical chart, the sentiment was telling you there was a negative divergence as well. And then I look at now, in January, we got up to a ridiculously high DSI of 96, while all of the numbers were off the chart. The 21-day moving average peak was 88 on the S&P. Well, spot DSI yesterday got to 85. The problem for me is the 21-day moving average still isn't high enough yet for me to feel comfortable that, you know, we've seen a peak. But on top of that, the price hasn't set a new high. For a negative divergence, you need a higher.
Yeah, you need a new high.
Yeah. But this is only a matter of time. This is one of the key ones I'm watching. When I see this 21-day moving average get back towards the high 70s, 80s maybe, that's when, because I don't expect it to get back to this number. I expect it to do what happened here. You're going to get a lower peak at a higher price, a lower peak, a negative divergence. The same thing expect with regard to these guys. I expect this to be a negatively divergent peak, this to be a negatively divergent peak, and this to be negatively divergent. So you put all of those together, plus all of the other indicators, credit, dollar yen, VIX, and you have a few signposts to tell you it's time to get out of Dodge. And here's how, my last slide, pre and post crash strategy. Equity puts, I've already got some QQQs, only a small allocation at this point, more a placeholder. But I plan to add more, and for the S&P as well. Facebook didn't do me any favor. They did on my QQQs, but I wanted to add puts in Facebook as well, but they've already shot the bolt, as it were. But to the extent that Amazon has good results, I'll be definitely looking to add puts on Amazon stock going into a crash in October, or if sooner or later than that. As I mentioned, oil falls with the stock market. You could see it if you look at Elliott Wave. You could see oil fall down to 26 again. Yeah, 26 or below. Yeah, 15. I don't need it to go that far, but you could see it fall that far. Put simply, I expect everything to dump except the yen, the dollar, and U.S. Treasury bonds. Precious metals, we were talking about gold earlier. There could be one more low there associated with a crash because the bullion banks hammer them lower, and because crashes are deflationary. So all commodities to fall to a lower low. I've been saying on my own site on Twitter that I expect commodities to bounce with stocks into these all-time highs in the S&P, and you're seeing that recently. I posted this yesterday, that you're seeing coffee bounce, you're seeing cotton bounce, you're seeing wheat. They're all starting to have a leg up. That's a false dawn. I think they're going to get hammered again one last time. But then that lower low, just like with gold and silver, you want to like back up the truck for that one. And this goes to my post-crash comment, which is that I expect, and I'm not alone, that the Fed and global central banks will reverse to QE and monetary stimulus on steroids. If that happens, buy everything. But I prefer precious metals, but stocks are going to go up, precious metals are going to go up. Treasuries, thanks to QE, the yields are going to go down, maybe even negative, much like in Europe. Prices go up. Commodities are going to soar. Basically everything except the dollar. And
that's how we get an S&P 4,200, but gold and miners will way outperform that. And that's how people think things are okay again, because the stock market rallies to new all-time highs.
Exactly, which goes back to my very first, what we talked about in February, is this scenario right here.
Got it.
And this is nominal. So when you tack on the inflation in real terms, you're talking about an 80-90% crash.
Yeah. What a great presentation, and you broke another record. The longest interview I've done in my career.
Oh my God, Dale, thanks very much. That's
another record, almost over an hour.
Well, I apologize. I'm grateful. But I apologize as well.
Oh no, it was outstanding, David, and this will be retweeted into infinity, I believe. And there's just one crisis, and I think you're probably prepared for it. And it's not global warming; it's the coming of another ice age. And I know it's cold up there already, but get backup for your pipes, because a lot of these guys that have been talking about a shift are talking about what's happening with the sun, and it's completely the opposite of global warming, especially if a few of these volcanoes go off, that we could have another mini ice age. It's happened before, but you're used to it anyway. You're a polar bear. So I'd like to thank you, David, for sharing, a great presentation that you took some time and thought to prepare, and glad to know you and appreciate your edification and sharing what isn't easy to say, because most people don't want to hear it. So I also appreciate your courage, my trading warrior brother, of laying out the facts as you see them.
Thanks, Dale. I mean, that's my mantra, basically, is doing just that. I apologize earlier because, Irishmen, a few of my colleagues and fellow Irishmen might disagree with me, but we like to talk. So you should actually see me on a few beers. This interview probably would have taken a few hours, but I appreciate you taking the time, is my point, and I appreciate your support. These interviews are a wonderful way to get the message out, and I do appreciate the comments from the interruptions from Steve too, because I like a dialogue as opposed to just me pontificating about what's happening in the world. But another thing about Irishmen gets us into trouble. We speak our minds, we're honest, and I put my money where my mouth is. I believe everything
Like
that I'm
that.
saying.
You did, yeah.
This isn't
Skin
me
in the
selling.
game.
Yes, the people I hate most in the world are car salesmen, but for that reason. But I believe everything I'm saying, and I thank you for the opportunity in being able to share this message with a lot of people. Because unfortunately, when these things happen, it's the little guy who gets crushed every single time. So the more people that can be made aware of this risk, the better. And I often get these comments basically that, oh, you prepared too early. It's better to be early than late when it comes to preparation. And you're going to get a crash and you're going to get another blow off top in the S&P. But dark times are ahead, as you said.
Yeah, but some great, really great once in a lifetime trading opportunities with these kinds of swings that are going to be there for us, besides what it's going to be like on the ground at ground zero. Really phenomenal, life-changing type trading opportunities that are setting up here in the next year or so.
Yeah, and I just want to say quickly on that point, Dale, with regard to gold and silver, you get a lot of people who are getting very concerned about gold and silver now and the drubbing it's taking, and now we're talking about new lows below 13 I've seen on silver and so forth. Yeah, maybe, but that's just typical sentiment at lows for me. When everybody's looking at gold to 700, 900 and silver to below 13, I start looking in the other direction. And even if it does go that low, trust me, when this all plays out, gold's going to be multiples higher. Silver's, we could be at $500 per ounce in silver. Will you really care if it falls from 16 to 13, if it's once it goes to 100, 200, 300, 400? The Chinese, the Russians, JP Morgan, they're all preparing for this. Just follow the smart money. Put it in a drawer, forget about it. You'll thank me in 3 years, 4 years. It's going to pay off handsomely.
Thank you, David. You're my second favorite Irishman.
Thank
Morrison.
David.
Van Morrison being number one.
And I have to take down his mantle.
Okay, buddy.
Thank you.
Everyone, thank David Brady. You can follow him. Go to his website at Pro Global Trader on Twitter, and this has been recorded, so it's going to be there for you guys to check all the way through the end of the year. We'll see how David does. So again, thank you, David. Good hunting. And that's a wrap for us today, everyone. Remember, don't just count your pips, count your blessings. And see everyone to wrap it up with TGIF. Enjoy the lunar eclipse tomorrow, and we'll have Moon Man, Norm Winsky, with us. Thanks again, David. Adios,
Thanks,
bro.
Dale.
You're very welcome. See you, Warriors. Talk to you tomorrow. Thank you, Steve, for helping me with the interview. See you tomorrow. Adios.